Bueno, pues nosotros ahora ponemos la mirada al marco económico con Eric Wograd, estratega jefe de Alliance Bernstein. Good afternoon, Eric.
Good afternoon. Thanks for having me.
It's a pleasure to have you here with us at Negocios Televisión. I would like to ask you, Eric, given the Fed's apparent tolerance for inflation slightly above target to support the labor market, do you think this signals as a structural shift in this reaction function, or perhaps an implied move toward an employment fix framework?
So I don't think it's a move toward focusing only on the employment side. I do think that they'll maintain their dual mandate of focusing both on the labor market and inflation. But you're right, it is a continuation of a move that's been underway for several years, where the Fed is a little more flexible about their inflation target, a little more willing to look through elevated inflation numbers to support the labor market. And that's what we expect. We have forecast all year that the Fed would cut rates 3 times. We continue to expect that. We think that they'll cut rates more than the market currently has priced as we move into 2026, because they're willing to look through higher inflation.
Mm-hmm. How confident are you that current inflationary pressures, which seem concentrated in less sticky components, will remain contained if trade frictions and tariffs persist into the next year?
So we think that inflation related to trade and tariffs will fade away. Tariffs aren't really inflationary. They represent a one-time boost in the price level as they go into effect, and then a year later they cease to matter to inflation in terms of the rate of change. There are some components of inflation that are less likely to come down, that are likely to be a little bit stickier, related to services inflation. But all in all, inflation is relatively contained, and inflation expectations are relatively well contained. And I think that gives the Fed the confidence that it needs to cut rates, even if inflation isn't all the way back to 2%.
Right, and we see that the market and the Fed now seem more aligned on the external terminal rate. In your view, does this convergence reflect genuine policy conviction, or simply the fading of fiscal uncertainty?
So I think it's a combination. Certainly uncertainty has faded, and not just fiscal uncertainty, right? We came into the year not knowing what fiscal policy would be or how the market would react to it. Now we know. We came into the year not knowing what trade and tariff policy would be, or how the market would react to it, or how the economy would, and now we have a lot more information on that. So there is a sense where fading of uncertainty leads to a narrowing of economic outcomes. But I think that the market is sort of two minds about this. You have some people who are more focused on the labor market, who think that rates could be cut aggressively, and some who are still more focused on inflation than I think the Fed is, and they think rates won't be cut at all. And of course the market pricing reflects the average of those two, which sort of ends right back up where the Fed seems to be at the moment.
And Eric, with consumption being heavily supported by high-income households, how sustainably is this dynamic if asset prices correct and the wealth effect begins to reverse?
Yeah, it is a vulnerability, and a bigger vulnerability than it has been. When we look at the economy today, what we see is that something like 50% of consumption is being done by the top 10% of households in terms of wealth. It has always been the case that the wealthier consume more, but the extent of that is greater now than it has been, and that does make the economy more vulnerable if the wealthy pull back. And of course, the wealthy have done extremely well because financial markets have done well. It isn't just the stock market, but also gold, also fixed income. Investors have made really, really great returns. That probably has supported consumption from the wealthy. If the market were to pull back sustainably, I think that you would expect to see the wealth effect go into reverse, a negative wealth effect, if you will, and that could serve to slow the economy. The good news here, though, is that the Fed's policy rate is above 4%. And if we were to see a disruptive move in the stock market, the Fed could cut rates more aggressively. That wouldn't necessarily prevent the stock market from going down, but it probably limits how far it is likely to go.
Not only the 2 next months, but also in the next year, right?
Correct. So I think the Fed is very set on cutting rates by 25 basis points in October. And because of the government shutdown, we're not going to get any data that will convince them otherwise, most likely. But as we move into 2026, if the economy slows more, or if the market performs in a way that is disruptive, the Fed has a lot of room to cut rates. It's a very important difference in this cycle relative to where we were in 2018, 2019, where the Fed was starting from a very low policy rate. They didn't have a lot of room to move. Now they do.
Right, Eric, as a last question, I would like to ask you, given the current curious balance in the labor market, where both supply and demand are softening, which leading indicators do you consider most useful for anticipating potential policy pivot or market inflection?
Yeah, it is a curious balance, right? Because there's very clearly been a decline in labor demand. After the tariff announcements in April, businesses really pulled back on their hiring. At the same time, because of migration policy, labor supply has fallen quite sharply, at least relative to the historical experience. And they are in balance, they're just in a curious balance that we haven't seen before. The things that we would look for in terms of signaling a change here would be a transition away from businesses not hiring into businesses actually laying people off. What we have right now is a situation where the business sector is frozen. They're not hiring aggressively, but neither do they appear to be firing people. If that changes, the situation will look very different. And of course, it's a challenge right now because, again, due to the government shutdown, we aren't getting great data on the labor market. Hopefully that will be resolved in the next few weeks and we'll be able to assess the economy more thoroughly. But really it is this transition, the potential transition from slow hiring to layoffs that would be most likely to spark a policy pivot, the kind of thing that would be most likely to change the outlook.
Such a huge indicator, and also we will be looking forward to that next meeting at the Federal Reserve, and looking forward to that shutdown that continues now for 15 years, if I'm...
15 days.
15 days, sorry.
Not 15 years yet.
Days, exactly. Yeah. Eric Wograd, estratega de jefe de Alliance Bernstein, thank you so much for being here with us today at Negocios Televisión. It's been a pleasure.
Thank you. It's my pleasure.